Hello, ORAT Nation. This is Dan Bird reporting on Wednesday, April 12th, a midweek update on the markets after the CPI report this morning. Some interesting developments as we went through the day. I'm going to make this a pretty quick one, so let me share my screen and get into it. First thing is the calendar. So as you can see, let me make this a little bit bigger. Hopefully. Well, maybe not. If you can see right here, CPI came in at 5.0. Last month was 6.0, so down a full percentage point. The forecasts were for 5.2, and as we talked about on Sunday with Zuber, we were anywhere from 5.6, 5.5, 5.6. I posed the question, what if it comes in at 5.3, which is significantly lower, but still above forecast? What will the market do? Well, it came in significantly below forecast, and the market took off in the morning, but then gave a lot of it, actually most of it, back by the afternoon, primarily after the 2 o'clock FOMC meetings notes were released, which I'll talk about at the end. The core CPI, however, last month came in at 5.5, and this month came in at forecast 5.6. So even though it came in at the forecast number, it was slightly higher than last month. So all of this, I think, pretty much assures we'll get another 0.25%, 25 basis point hike on May 3rd. Tomorrow we have the PPI, so I think PPI is going to come down as well. We'll see. Let's see. Down here is core PPI. They're showing it to be increasing. The forecast shows it increasing. Month over month, yeah, increasing. So PPI looks like it's forecasted to be increasing tomorrow. So we'll see what that comes in at and what effect it might have. I'll show you the charts in a second, but I think the market is probably going to be heading lower in the short term. And I'll show you why here in a second. But first, let's look at some charts. Let's first look at headline CPI. So I've moved this blue box over to today's number, even though today's number does not get reflected in the charts until the end of the month, because these are monthly views. So at the end of the month, this will get reflected in the chart. And this will be the current 12-month window. So you can see with headline CPI, we talked about this before, this big gap right here is what fell off this month in today's report for headline CPI. So that's one of the reasons, contributing factors of why it went from 6 to 5. You can see down here the 12-month rate of change for headline, and below that is the 12-month rate of change for core. You see core went up slightly while headline went down significantly. And again, this won't be reflected in the chart until next month, but that's what it will look like. So let's look at headline, of course, is basically a basket of different components that make up CPI, typically things that everyone buys, and it includes energy and food, while core CPI strips out energy and food. And that's probably one of the reasons why it actually went up slightly from last month, but it hit forecast for this month. So down here, this is the 12-month rate of change for core and 12-month rate of change for headline. You can see the difference between those two. So core actually went up slightly while headline went down a lot. But if you look here, the gap of the 12-month window was much smaller for core CPI, whereas next month it's going to be a little bit wider. However, for next month on headline CPI, the gap that's going to fall off next month is much smaller. So what that will mean is these two things might end up getting reversed, where headline CPI will start ramping up, core CPI might stay static, or it might ramp up a little bit, and I'll show you why using this chart. This is the chart of all the rate hikes ever since they began way back in March. First quarter point rate hike right here. I drew arrows up to the S&P to show you what the effect of rate hikes had been on the market. And you can see once they first started, the market headed much lower. This big gap right in here is when Powell had his famous speech at Jackson Hole saying there's a lot more pain ahead, and the market sold off in June. It rallied back up and then sold off again to the bottom here in October, and we've been rallying since then. This is the next quarter point right here at the end, this last line. So that is the one that I'm expecting will come in, and probably will be the last one. I'm thinking it will be the last one. But here's the reason why next month's CPI report may not look very good and might cause some huge consternation in the markets. You can see here the shaded area is what the current one, the one that was reported today, is based on the shaded area, which is last month, but primarily it's the first couple of weeks in the month where we had this big, huge trough. So all of this kind of fell off. This is oil, gasoline. CRB is made up of agriculture, so food, as well as metals. So all of this dropped off in the middle of the month, which is primarily what the CPI is made up of, although they stripped out food and energy for the core CPI. But next month, it's going much higher. In fact, it's actually exceeding these peaks that we saw back here in March. And gasoline, in fact, is heading back to, it's actually at a high we haven't seen since last August. So gasoline is heading up and oil too is heading up. So all of this is going to combine next month, and the Fed is watching this as well, which is why I think they'll most likely do a quarter point. Next month, there are a number of factors that will combine to probably have a worse inflation report. One is the much smaller gap here that's going to drop off in headline CPI. That will have an effect. And the other one is the amount that this has gone up. All of these commodities have gone up quite a bit. And it looks like they will continue to go up. So next month's CPI number probably is not going to look very good. I said earlier that we might have a 6-week run in the stock market. I still think that that's probably true. Before I look at the actual charts of the market, let's look at PPI because this comes in tomorrow. So PPI is actually forecast to be higher. So if that's true, this is the chart all the way back to before the pandemic. So you can see how much it ramped up, the producer price index. But lately it's come down. It jumped a little bit, came back down again, and we might get another little hike here. So this also will, if that happens, and we'll know tomorrow, if that happens, also will reinforce that the Fed will probably hike again. And most likely are going to hike again on May 3rd. So the S&P, here's what the S&P looks like. You can see they had a nice little rally in the morning after the CPI number came in, but then it sold off, especially in the afternoon, sold off quite a bit. And if we look at the 1 hour chart, this brings it, this shows it pretty clearly. A little bit of a gap higher right in the beginning, then it sold off, then we started back up again, and then starting at around 2 o'clock, sold off with the FOMC meeting minutes when they came out. You can see the momentum indicators on this one. Remember, this is a 1 hour, 65-minute chart. The momentum indicators are heading lower in all cases. So this is probably going to continue lower. So in the S&P, what we're watching, anytime you have a rally like we've had, we want to watch the 21-day moving average, which is that blue line right there. Right now it's at 40.45 and it's rising. So it may get up to roughly around 40.50. So we would like to see the S&P hold 40.50. It's okay for it to come back down to it if it then starts back up again. Worst case to hold around 4,000, which is where the 50-day moving and the 200-day is a little below that at 39.50. But we like to see it hold 40.50. So that's the one to watch. On the 65-minute chart, I actually put that line in right here. So that's the 40.50 line, which is also a support line from last week, right in through here. So we'd like for it to hold that area. We'll see what happens tomorrow. All in all, it looks like the market wants to go down again tomorrow, mostly because all of these indicators, the RSI up here, these are the momentum indicators. So the RSI is rolling over, and the PPO here is rolling over as well. Now, when we look at the NASDAQ 100, it's even more pronounced. So on the daily chart, you can see we have a negative divergence or a bearish divergence. That's when, and I always like to look for divergences. There really wasn't too much of one on the S&P, but on the NASDAQ, there definitely is. So for those out there that are learning technical analysis, divergences can be very powerful. So you want to keep an eye out for them. In this case, you can see the price went higher. The same time, the RSI, or relative strength index, went lower. So relative strength could not make a new high at the same time that price was making a new high. And the way to read that is the rally here basically is running out of steam. So it's starting to roll over right there. You can see today's big red candle. And now for this one, the 21-day is not very far away. So I suspect that probably we're going to continue to go down. You can see also the negative divergence down here on the PPO. This is a momentum indicator as well. And this one is even more clear. And this one is rolling over and has actually crossed. So it's very likely, you can see the histogram has crossed below zero, in fact. So it's very likely that this is going to continue to go down, and the market will continue to go down. The NASDAQ and technology stocks and growth stocks, those things will probably continue down. I think it's going to probably break through the 21-day, and then we'll have to watch to see if the 50-day and the 200-day, which is at 12,000, can hold below that. If we look at a 65-day, 65-minute, 1 hour chart, you can see again what happened at the end of the day here. We had a little gap up in the morning, and then it sold off, tried to recover, and then after the FOMC minutes came out at 2 o'clock, it sold off pretty heavily with pretty good volume as well. Same thing down here with the RSI. RSI is trending lower. The PPO is trending lower. I think most likely this line right here, this dashed line, is the 21-day moving average. It probably is going to break through it. That's at 12,782 right now. And the next support level is down here at 12,550 roughly. Let's call it 12.5. In fact, the 200-day moving average is at 12.5. So 12,500 is the next major support level that we need to watch. I think it's probably going to get there, but we'll keep an eye on that, see what happens. So the FOMC minutes, the biggest thing that they talked about was expecting the banking crisis to cause a recession this year. So it looks like the banking crisis has had an effect. Some of the folks on the committee actually wanted to go with half a point this last time. But because of the SVB collapse, they went with a quarter instead. So if there had not been a crisis, then they might have done a half point instead. And we had talked about that before. And then finally, they changed the wording a little bit. The previous statement referred to the need for ongoing increases, where now they're saying change the phrasing to indicate more hikes may be appropriate. I think that's setting things up for the final hike on May 3rd. And the wording at that point might still stay maybe appropriate, but they might start indicating that they're going to wait and see what the effects of all of this, especially if there's another banking crisis for sure. But I think that they're probably going to hike another quarter point. I think that we're going to have bad CPI numbers, or not very good ones, in May for the April month. And then after that, the numbers are going to start declining rapidly. So we may have a few bearish times in the market. I still think we've got a chance of heading higher for the next few weeks, especially if we can negotiate this current downtrend right here, where the market looks like it wants to roll over, wants to go down. We'll see if it can hold this pink line. If we can hold some of these support levels, then I think we still might have a chance of going higher, maybe up to 4,200. But be careful of the CPI report in May and core CPI as well. I think they are not going to come in very well. Anyway, that's my report for today. Hope that was helpful. And we will perhaps see you on Sunday. I think Zuber will not be available Sunday, but I'm going to see if I can do one on my own anyway on Sunday for everybody, just to wrap up the week. So that's where we are. Hope everyone has a good week, and thanks for listening. Oh, by the way, let me share my screen again. I always forget to do this when Zuber's not on. Look at my newsletter if anyone is interested. I send a newsletter out every week. I think most folks are getting this now. But if you would like to join, there's no charge. It's free. I don't sell email addresses or any of that. This is mostly for myself and for friends and family. And now I share it with folks on this channel. But if you're interested, just send me an email to breakpointtrading@gmail.com, and I'll send you last week's newsletter and put you on the list for next week. Okay, so thanks everyone, and hope you have a great week. Take care.